Hi and welcome to Swissquote's Daily Market Talk. It's Wednesday, September 10th. The S&P 500 traded close to an all-time high level yesterday after the BLS reported a big revision to annual jobs figures to the downside and ahead of the most critical inflation numbers that will land between today and tomorrow, and which will tell what's the inflation situation in the US. Then, gold and oil jumped on mounting geopolitical tensions after Israel bombed Qatar, while the FTSE 100 in the UK benefits from increased appetite for energy and commodities. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So those who watch these episodes quite regularly remember how surprising it was to see strong and much better than expected NFP reports in the US month after month at a time mass firings, mass deportations, and tariff-led uncertainty among companies were supposed to, somehow weaken the US jobs market. Well, you know what? It appears that we were right to be surprised due to the strong NFP figures and that the numbers were not all that accurate after all. Indeed, the BLS announced yesterday that the payrolls report could be revised down by 911,000 jobs for the next 12 months through March, some 76,000 numbers less for each month. So that would be a record high revision in the history of the BLS. And in simpler words, it would mean that the US jobs market is in a much worse shape than we thought it was. But it's not the BLS fault, it's not S fault. The BLS actually releases these jobs figures just a few days following the end of a month or the previous month. So it's really, really quick. And to be able to do that, they actually take a sample of their data and they extrapolate, so they guess. And in normal times, the latter works quite well and gives investors and economies and the markets and whoever needs this data an early and quite an accurate picture of the health of the underlying jobs market in the United States. But in times of heavy disturbances like the one that we have been seeing since the beginning of this year, mind you, the extrapolation that the BLS does actually seems to be working much less efficiently, and the numbers are much less surprisingly pointing that the US economy is actually bearing the brunt of Donald Trump policies. So that means that the Federal Reserve may have well fallen behind the curve, at least on the jobs front, while trying to anticipate a tariff-led heating in its inflation numbers. The latter could eventually mean bigger and faster rate cuts in the coming months from the Fed, but depending on inflation. So today, US will be publishing its latest PPI update for August. After last month's jump of around 1 percentage point, the headline PPI is now expected to have steadied near the 3.3% level on a yearly basis, and core PPI may have eased from 3.7% to 3.5% on an annual basis as well. But the real question is if and how much of the rising input prices will be reflected in the consumer price index that is due to be released tomorrow. So the idea goes, the stronger the inflation figures in the United States, the slower the Fed will be able to lower its interest rates in the coming months, and the latter could eventually demoralize investors that are quite happy today to see the jobs market weaken, because weaker jobs eventually means higher rate cuts from the Fed, and that's really good for equity valuations. As such, yesterday's BLS revision didn't really boost appetite in the US 2-year bonds that best capture the Fed expectations. The US 2-year actually rebounded to 3.55% yesterday, while the US dollar somehow recovered in yesterday's trading session on higher yields, but also on a certain safe haven buying on rising geopolitical tensions in the Middle East following Israel's bombing of the Qatari capital Doha. So activity on Fed funds futures, on the other hand, now gives a 100% probability for at least a 25 basis point cut at next week's FOMC meeting and some 8% chance for a 50 basis point cut. So stronger than expected inflation numbers from the US this week could cement the idea of a 25 basis point cut, which could then lead to an upside correction in the US short-term yields because it wouldn't be a 50 basis point cut, and the latter could also ramp up the US dollar and weigh on equity appetite, while a set of softer than expected inflation figures from the US this week should give a heavier weight to the possibility of a 50 basis point cut from the FOMC meeting next week, send the US short-term yields and the US dollar lower and equities higher due to prospects of lower interest rates in the US. So the S&P 500 consolidated gains yesterday near an all-time high level, as the Nasdaq. The technology stocks were in demand except for Apple, mind you, where the thinnest iPhone, but no breaking news on AI whatsoever, sent the price of Apple 1.5% lower after the new product reveal. Then a new company called Nebius, on the other hand, jumped 50% yesterday after Microsoft announced a 5-year agreement with this neo-cloud company, initially valued at $17.4 billion US dollars, with the option to scale up to around $19.4 billion US dollars depending on its compute needs. Jackpot for Nebius, another Microsoft neo-cloud provider, and which is the NVIDIA-backed very CoreWeave, also jumped 7% at yesterday's trading session, as the Microsoft deal with Nebius confirmed how strong the demand for AI computing capacity is. So NVIDIA on its end recovered 1.5% yesterday, while Broadcom, that had surfed on the news of its cooperation with OpenAI earlier this month to produce an AI chip to rival NVIDIA's ultra-efficient chips, gave back 2.60% yesterday. Then finally, Oracle rocketed 28% in the after-hours trading. Yes, 28%, following its own massive deal with OpenAI and a jump in latest quarterly booking. So in summary, AI doesn't know crisis. And speaking of crisis, if you're wondering how the French markets and the French assets behaved after the government collapse and the country had to appoint its fifth prime minister in less than 2 years, well, you would be quite surprised to hear that the French CAC 40 eked out a 0.19% gain yesterday despite a rebound in French 10-year yields. So the DAX, in contrast, is 0.37%. But still, the spread between the French and German 10-year yields spiked above the 80 basis points level, hinting at stress, while the one compared to the Italian 10-year yield collapsed to zero for the very first time since around early 2000s. And Fitch is scheduled to deliver its review of France's sovereign credit rating this week. And the current rating for France is actually AA- with a negative outlook, which is not brilliant. A confirmation with a negative outlook actually sends a signal to investors of cautious sentiment, and that could eventually reinforce market concerns about France and its exploding debt levels and incapacity, political deadlock to rein in, while a downgrade, God forbid, due to a long period of political uncertainty with no light at the end of the tunnel would be material, possibly triggering forced selling by institutional investors who must adhere to minimum credit thresholds despite the fact that they don't hate France. So for Euro, that will mean a limited upside potential as well, and a potential reversal of the recent gains before reaching the 120 level against the US dollar. And also on Thursday, note that the European Central Bank is expected to maintain its interest rates unchanged, and repeat that their monetary policy remains very much data dependent. In the commodity space, gold refreshed record yesterday, this time on safe haven purchases following an Israeli attack on the Qatari capital Doha, as I said before, to strike Hamas leaders, while crude oil remains bid on rising Middle East tensions and waning hopes of seeing peace in Ukraine anytime soon. Nat gas futures also rebound from a key Fibonacci support, mind you, and could eventually extend gains on fresh geopolitical tensions that we see in the Middle East. So in this environment, UK's energy and miner heavy FTSE 100 index continues to be supported by the rising commodity demand across the board and the rising commodity prices as a result of it. So yesterday's mega deal where Anglo American agreed to buy the Canadian Teck Resources for its copper mines actually added to the positive momentum in the FTSE 100 index. So it's all about real and tangible assets now that confidence in the most popular sovereign debt papers is crumbling, and FTSE 100 answers that demand quite well. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.